Good afternoon, ladies and gentlemen. And on behalf of all of us at Peerage Capital, our colleagues, family, friends, and partners, and our partners at CIBC, we want to welcome you to a conversation with Benjamin Tal. When I thought about it, there are very few people that require no introduction, and Benjamin Tal is one of them. He's the Chief Economist at CIBC, as you know, and he's an extraordinary human being who's got an exceptional ability to distill complex macroeconomic trends to very simple ideas. I will tell you on a personal note that over the last 16 months that I've been talking to him, at the beginning and throughout COVID, he's been right on the money and exceedingly accurate at predicting interest rates, inflation, the economy, housing demand, and the stock market. He's been a wonderful source of information for us for many years, and we thought it'd be a great privilege to share this with our 250 closest friends this afternoon. So without further ado, it's my privilege to introduce the Chief Economist of CIBC, Mr. Benjamin Tal. Benjamin, why don't you were kind enough to offer to share some slides in advance, and then we'll have a question and answer.
Yes, thank you very much. And obviously a lot to talk about, and as usual, not enough time. So I will go relatively quickly over the presentation, and then we have a chat and see what makes sense and what doesn't, because we are trying to normalize basically the abnormal. So we'll talk a little bit about the tug of war between the vaccine and the virus, what it means economically speaking, the risk of a fourth wave, the trajectory of the recovery, which I believe will be very, very strong, what we see when it comes to interest rates, inflation, should we lose sleep over inflation? How short-lived is it, if at all? We'll discuss. We'll discuss government policy, too much maybe, more directed, not directed enough. We'll discuss. And if we have time, of course, the housing market, why the housing market is doing what it is doing, what it means, how sustainable it is. And then, of course, to what extent COVID-19 is an event or a condition. Let's start very quickly, and let's go with the first chart to illustrate how this market is changing. This is the US market and how people are looking at the recovery. You can see that until very recently, the market was not too enthusiastic about the recovery. They believe that yes, things will go up, but then they will stay below the 2019 level for a long period of time. Now, if you follow the black line, you can see that not only is the market expecting the economy to recover to a pre-recession level, but actually to exceed it and close the output gap in a very significant way. In addition to reopening, something else is happening in the US economy, and that's the next chart. And of course, here I'm talking about Biden. We think that Trudeau is generous, and he is, but Biden is much more generous. We are talking about, as you all know, $1.9 trillion of money being injected into the US economy in one short year. That's 10% of the economy. So you have three things happening at the same time. The US economy is opening up, demand is rising, shopping is happening. At the same time, you have Biden injecting $1.9 trillion into the economy, and you have interest rates basically at zero. Listen, if you generate enough wind, even pigs can fly. And that's exactly what we are seeing in the US economy with 10% GDP growth as we talk in the current quarter. This is something that we haven't seen in a long period of time. Now, Canada is lagging behind. Canada is lagging behind first because we are starting from behind. You see, during COVID, and that's very important to understand, for a given level of infection, the US economy was about 20 to 25% more open than the Canadian economy. So the negative spin for them, of course, was their infection rate was higher. The positive spin, economically speaking, they did better. Their unemployment rate did not rise as much. Their GDP did not go down as much. So we have to start running faster to stay in the same place, but we are not running faster because our fiscal support is not as strong as theirs, and therefore they will basically finish and reach the finish line earlier than Canada. That's very, very important to understand. This is true. So in relative terms, the US is ahead of us. In absolute terms, however, Canada is still going to do extremely well. We are talking about GDP growth over the next 6 months of, I believe, 7 to 8% on an annual basis. Why? Let's go to the next chart and discuss. First of all, we all know now, economically speaking, how to deal and how to function with the virus. Look at this. This is the economy during the waves. The first wave, everything went down. The economy went down a free fall because we didn't know what happened. Look at the second wave. Medically speaking, the second wave was actually worse than the first wave, but economically speaking, like nothing happened. Same goes for the third wave, and I think that will be the case if we have a fourth wave in the fall. Now, the question is why the economy is going to recover so fast. One, because we know how to live with the virus. Second, is that that's very important to understand. The damage of COVID was very, very deep, but also very narrow. If you are a hospital, if you are in the hospitality business, if you are in a restaurant, if you are a small business in the service sector, you feel the pain. But the number of sectors and companies that felt the pain was relatively small compared to any other recession. And remember, there is government support in the background. So the damage is very, very narrow, although it is deep, which means that when we start recovering, the recovery will be much, much stronger and faster. That's one thing. The other is the asymmetrical nature of the crisis. As you all know, all the jobs that were lost in low-paying jobs, service-oriented jobs. All the damage of COVID is in the service sector. Why? When it comes to goods, you press a button and you get your exercise bike, no issue. The issue is services. And services actually went down dramatically. That's the bad news. The good news, it is much easier to start a new restaurant than to establish a new manufacturing facility. So we have a situation in which the service sector will rebound very quickly. Another factor that will lead to a relatively rapid trajectory when it comes to the improvement. And then the third factor, which we are all familiar with, is the next slide, and that's the cash factor. We are sitting on $100 billion of excess cash because, again, all the jobs lost were low-paying jobs. High-paying jobs, their number is up by 350,000 positions. So people have their job, they have their income, their spending is down by 35%, their checking account is getting larger and larger, $100 billion of excess cash. This is just individuals. And then you go to the next chart, and we are talking about businesses sitting on roughly $130 billion of excess cash. Together, we are talking about $230 billion of excess cash in checking accounts looking for direction. This money is pent-up demand that will be utilized. The finance minister asked, how can we convince all those people to spend that money? And I said, provide the vaccine and get out of the way. They don't need any motivation. They are motivated enough. What they need is basically the green light, and we are getting the green light. So overall, all those factors, the very, very narrow but deep factor, the service flexibility factor, and clearly the cash aspect, all those suggest that the trajectory of the recovery will be strong. That's the good news. Now let's talk about the no free lunch part of this story. And let's go to the next chart. And the next chart is basically the government. And who is going to pay down that debt? And the answer is nobody. Why? Because as you can see from this chart, governments do not pay down debt. Margaret Thatcher in the 80s said, governments are like families. They have to balance their budget. They have to pay down the debt. No. Governments are not families because families don't have the Bank of Canada. We have a situation in which this money will be recycled and will be basically refinanced. And despite the fact that the debt level is rising, and we all know the numbers, debt payments are actually down by $4 billion because of refinancing, taking advantage of low interest rates. It means that the government of Canada is becoming more and more sensitive to the risk of higher interest rates, and we'll talk about interest rates in a second. Let's go to the next chart very, very quickly and discuss the real issue that is fiscal policy. And here I'm talking about what I believe is a permanent increase in government spending. You see, as you can see from this chart, before the crisis, government spending as a share of GDP was about 15%. Now it's about 35%, unsustainable, crazy. It will go down. But when it goes down, it will stabilize maybe at 18, 19, 20%. Why? Because without noticing that, we are putting together the infrastructure, the plumbing for tomorrow's social assistance program. We have this national daycare system that's $30 billion over 5 years, and an additional $3 or $4 billion a year after that. We're talking about making the EI system modified, permanent. That's going to cost you money. All those forces, to me, suggest that you have a situation in which the government is going to see its spending rising on a permanent basis. That's very, very important to understand. The question is, who's going to pay for it? And I believe all of us will pay for it. I believe that as you see in the US, as you see in the UK, taxes in Canada will rise maybe after the next election that is coming. As you know, I think that it's not unthinkable to believe that the inclusion rate on capital gain tax will rise, maybe something on dividends. And if they're desperate enough, they will go after GST. 1% increase in GST will give you about $7 billion like that. Now, I don't know, I'm not predicting, I'm just saying it's not unthinkable that you're going to see an increase in government spending that will be financed in part by higher taxes, especially on capital gain. Very quickly, what it means. Now, if you're under the age of 30, you probably don't know the meaning of the following word. There is a word in the English language. This word is inflation. If you go to the next chart, you can see that actually I checked in the dictionary to see if inflation is still a word in the English language. It is. Should we lose sleep over inflation? We definitely, if you are into the market, if you are playing in the market, if you are investing, you must think about inflation and how permanent it is, how short-lived it is. And let me tell you something before we start analyzing it. Nobody knows where inflation will be 6 or 12 months from now. Nobody. And I include the Fed and the Bank of Canada in that nobody. We're all pretending to know, but nobody knows. So at the minimum, we have to analyze it and make some assumptions. So let's discuss for a second to what extent we should lose sleep over inflation. Let's go to the next chart. Money supply is the #1 factor that is impacting inflation. And as you can see, money supply is now rising. It is rising quickly at 20%. Now you go to Economics 101, the textbook, and it will tell you if you have money supply rising at 20%, you have not only inflation, you have hyperinflation. But also, if you go to the footnotes in the same page, you will see that it will say that in order to see inflation, you need not only money supply to rise, but also the velocity of money, the speed at which money is exchanging hands to rise. And we know that until now, people were sitting on this mountain of cash, and now they're starting to spend it. So velocity is starting to rise. And at the same time, you have to remove liquidity from the system. That's a tug of war now between the Fed, the Bank of Canada, and the market. To what extent they will be able to remove enough liquidity from the market when velocity is up. That's the issue. Now, let's discuss this inflation. Let's go to the next chart. It's not just demand, it's also supply. Are we okay? Can we go to the next chart? Yep. This chart is telling you, no, then let's go to the previous one. This one is the supply issue that we are facing. And no, the previous one, please. Yep, this one. This is the supply issue that we are facing. This is the containers that are stuck in China. We all know the story. And it's becoming worse and worse. We talk to businesses, they feel the pain. Clearly, you see it in construction, you see it everywhere. And the more I talk to people, the more I realize that this is not going to be resolved in 2 weeks. This is a 6-month story at the minimum. So we have some inflationary issues here. Now, what's important here is that those companies that are facing higher cost are able to transfer that cost to the consumer. Why? Because this consumer, its price sensitivity is much lower than it used to be because this consumer is dying to spend and he or she have the money. They have the money because they sit on the mountain of cash. So if you want to get your haircut, you're not going to bargain over $5, and therefore more consumers will be willing to accept higher prices, and therefore you see margins of companies remaining okay while consumers are paying more and they are willing to do so given the pent-up demand. There is another aspect here, and that's the next chart. Wages are rising. Wages are rising. And the question is why? And the answer is that you don't have enough people. If you go to a restaurant now, you can see that you don't have enough people working there. You go to a health clinic, they don't have enough people working there because people don't want to go back to work because they get $2,000 a month from the government. This chart is telling you something very interesting. You have basically, what we do, we look at countries that open up ahead of us to see what's going to happen. That's the way we try to predict what will happen in Canada. So you have two models. One is New Zealand, Australia. The other is the US and Israel. All of them are ahead of us. New Zealand and Australia mostly focused on wage subsidies, while the US and Israel direct support to individuals, direct deposit. And you can see that in New Zealand and Australia, the situation is much better in the labor market than in Israel and the US. Why? Because when you have a wage subsidy, you have a link, a connection between the employers and the employee. When you just send checks to people, you don't have the connection. And you see that people don't really want to go back to work as long as they collect money. So job vacancies in the US and Israel, and now starting in Canada, are rising to record highs because people simply stay at home. That's something that will continue to be the case until we stop government support. Now, why all this is important? Let's go to the next chart. And that's basically the sensitivity to higher interest rates. We have a situation in which, as a society, we are much more sensitive to the risk of higher interest rates. Every basis point counts. This measure, as you can see from the chart to the right, is basically how sensitive we are, and it's rising and rising and rising, highly correlated with the mortgage market and the level of debt carried by people, which means that the Bank of Canada is very powerful. The minute they start raising interest rates, you will feel the pain. I estimate that raising rates now by 1% is equivalent to raising them by 1.4% just a few years ago. Every basis point counts. You basically raise rates by 1.2%, you double somebody's mortgage payments. That's significant. So the fact that interest rates are low and will remain low is irrelevant, given the fact that all the debt taken in Canada was taken in a low interest rate environment. So it's irrelevant. What's relevant is how quickly it will rise. And here is the key issue. Let me repeat. Nobody knows where inflation will be. So something very interesting happened over the past few weeks. The Fed is telling you that it is going to move a little bit earlier than expected, and inflation is rising much faster than expected. Still, the bond market is improving, and the 10-year rate went down. Why? Because the number one risk facing the economy is the risk of a monetary policy error. Now listen to this, because this is crucial to your business. The history of housing market corrections and recessions is the history of monetary policy errors. When you have a situation in which central banks raise interest rates way too quickly. Why? It happened because inflation is a lagging indicator, is not moving with the economy to the extent that it should. It's moving behind the economy. Therefore, when you have a situation in which inflation gets too close, you are chasing a lagging indicator. And when you chase a lagging indicator, you tend to panic and you raise interest rates way too quickly. If you look at 2008, what triggered that crisis was the fact that before that, Greenspan raised interest rates from 1% to 5.25 over the course of breakfast. It did not cause the crisis, but it triggered it. So the risk is that the Fed or the Bank of Canada will wait and wait and wait and wait and then start raising interest rates in a panic that will derail the market. Recently, the Bank of Canada is telling us, you know what, we were thinking 2023. Now we are telling you that the first move will be 2022. The Fed is starting to tweet about this direction. And therefore, the market is starting to realize that maybe if the Fed and the Bank of Canada move a little bit earlier than expected, they will not be behind the curve and there will not be a need to raise interest rates very quickly. That's more or less where we are. And that's very important to understand. And if I were you, when it comes to interest rates, the 10-year rate, that's where I will focus on. Because I think That's going to determine the trajectory of the next cycle. Very, very quickly, let me just share a few observations about the housing market. Next chart. I believe that cities will be back. We have seen the Toronto refugees, the Vancouver refugees, people leaving the cities and moving to 2 or 3 hour drive because they can afford it, they can work from home. I think that trend will reverse itself because cities will be back. And that's why I believe that the condo space actually will do extremely well, because if you go to the next chart, you can see that the market is starting to slow down. The market is starting to slow down. We have to realize two things are happening. One is that I believe that in the low-rise segment of the market, we have reached what I call a resistance level. Namely, prices rose way too quickly. People simply cannot afford it. The other issue is that people are blinded by those low interest rates. And there is a sense of urgency to get into the market. So if you wanted to buy something a year from now, you're buying it now. So you have a situation in which we are borrowing activity from the future. And to an extent, the future has arrived. And that's why we see the market slowing down. And that's a very, very healthy environment. You go to the next chart, and you can see that about 50% of home price inflation was due to the compositional factor, namely the fact that people were buying detached houses as opposed to condos. Given the fact that people were buying detached houses that are more expensive, you have more activity happening in the more expensive segment of the market, and that's something that led to higher prices. If I'm right, or even semi-right, and the low-rise segment of the market is reaching a resistance level, and the only affordable channel is the condo space, and cities are opening up, you will see the condo space taking over and improving relative to the low-rise, and that's something that will be disinflationary through the compositional factor. Very, very important to understand, because you will see more activity happening in the condo space as opposed to the low-rise. And again, the issue, of course, is supply. Very, very important. Let's go to the next chart, and you can see that almost all the improvement and the increase in mortgages over COVID was in uninsured mortgages. Insured mortgages, basically not there. And the share of the insured segment of the market going down and down and down. So you have more and more people able to come up with more than 20% down payment to avoid insurance. How can they do that? Let's go to the next chart, and we can see that a significant increase in gifting. This is something that we did with Equifax, and we looked at people buying houses, and we look at their parents. In the same day of the transaction, we saw that the lines of credit of parents has risen notably all over the country, which means that parents are taking advantage of low interest rates, take themselves debt, and help their kids to get into the market due to this urgency to get into the market. Another observation that I would like to share with you is to what extent there is speculations in the market. One way of measuring it is how quickly people sell the house after they buy it. You go to the next chart, and you can see that houses that are 3 years old, their share going down and down and down, which means that really you don't see any major speculations happening in the market. This is not a speculative market. This is not a flipping market. This is a normally functioning market with a sense of urgency to get into. The last point that I will make is I believe that yes, COVID-19 has changed many trends. Every crisis is a trend accelerator. And we have seen all those trends being accelerated: e-commerce, e-health, e-education, and that will continue. But economically speaking, namely the speed limit of the economy, the ability of the economy to grow, I still believe that from this perspective, COVID-19 is not a condition, it is an event. It did not impact the ability of the economy to grow. The production capacity was not changed, and the willingness and the ability to buy and spend did not change. We simply are waiting for a green light. So yes, the global economy is being transformed, but when the fog clears, everything will look very familiar. I will stop here and see if we have some time for a chat.
This is extremely helpful and very insightful. I wanted to drill down into some of the micro impact of these trends that you discussed and the insights you provided, which were so valuable. So pre-COVID, the 10-year was at about 50 basis points. It peaked in June of this year at 1.74. It's now about 1.35%. One of the questions in the minds of the people on the phone who are making long-term capital allocation decisions, you said nobody knows where the Treasury 10-year bond will be. But if you had to handicap higher, lower, or the same over the next 1, 3, 5 years, because people are making, if you're in the real estate business, you're making long-term investments, what would you say the trend is?
Yes, I don't think that the trend is down. I think that the trend is up, but I think it will be a very modest increase. Namely, the long-term, the 10-year rate should be around 2%. That's the average that we have seen, and that's reasonable from economic perspective, given the nature of the economy. The 1.5 does not reflect where it should be, but I think it will take a while to get to 2%. But if I have to guess, over the next 5 years, it will be closer to 2 or to 1. I would say it will closer to 2. I think that 1.7, 1.8 is a reasonable guess over the next few years at one point.
So both economies in the United States and Canada have enjoyed a wonderful rebound. If you were to put relative weighting on which economy performs best over the next 1, 3, 5 years, are you more bullish on the US economy, or are you more bullish on the Canadian economy over a period of time?
I think that over the next 2 years or so, I'm more bullish, quite frankly, on the Canadian economy, just because of the global economy opening up and the commodities space, which of course will have positive impact on Canada. The oil story is another positive story. The fiscal story in the US is positive, but it's short-lived, and it will not really lift you 2 or 3 years from now. Canada also is benefiting from what's happening in the US. So overall, I'm very bullish on Canada over the next 2 years. I think that Canada will outperform. Beyond that, it's very difficult to predict. I think it will be more or less the same.
So oil is one of those stories. It's had an amazing appreciation from, I don't know, $35 up to $75. Is that a story about reduced supply or increased demand? And where does that level out over a period of time?
I think that the story regarding oil at this point, although we know that OPEC and OPEC Plus has all kinds of issues, and we all read the newspapers, but I think that clearly the move from 30 to 70 is a move reflecting an opening up in the economy demand, and 70 is basically where we should be. 30 was a recessionary level. So in terms of demand, normal demand, people driving, opening up, investment happening, 70 to 80 bucks a barrel, I think is a very reasonable, regardless of what's happening with supply. And I think supply will be fine.
And how much of an impact is higher oil going to have on the Canadian economy? Is it a profound impact, material impact, or modest?
Well, if you live in Alberta, it's very, very significant. Overall, for GDP, it's basically 2 or 3 decimal points. So it's not a game changer, but it's a positive. For Alberta, it's a big positive. Overall, clearly a positive for Canada.
So you have people that are North American investors on the line. The Canadian dollar, bottomed out at a year ago at 74, hit a peak in June of this year of 83, and then it's now trading about 80 cents on the dollar. If you had to look forward a year, 2 years from now, what do you think the Canadian dollar against the US dollar trades for?
Yeah, as you know, currencies have their own mind, very difficult to predict. But let's look at 2 factors that impact the currency at any given point in time. One is commodity prices. The other is the spread between US and Canadian interest rates. Those are the 2 factors that you really want to focus on. Commodity prices have risen dramatically, as we all know. We know what happened to lumber lately, going down. So what I suggest is that the commodity story will be neutral at the minimum. Okay, not going to accelerate. It still remain elevated, but not going up. So what's left is the other part. Now, the other part is very, very important, because what the market is now pricing in still is the situation in which the Bank of Canada will be moving almost a full year ahead of the Fed, and by much more. This does not make any sense, because Canada will not grow as quickly as the US in the short term. And inflation in Canada will not be as high as in the US. So all those forces to me suggest that the market is mispricing the move. It's not the move by the Bank of Canada, it's the move by the Fed. And to the extent that the market will start realizing that the Fed will be moving much earlier than expected, as I discussed earlier, that will shave a few cents out of the dollar. So if I have to guess over the next year, I will see stable to lower dollar as opposed to stable to higher dollar.
So one of the beneficiary of all these policies has been the stock market. S&P 500, a year ago was at just under 3,200. Today it's about 4,360, up 37%. When you look at that, what do you look for as a trend by the end of the year, a year from now? What's a normalized rate of appreciation in your own expectation from your models?
You see, I think that clearly when people say, how is it possible that the stock market went up when the economy went down, is because of the fact that the stock market is not the economy. The stock market is highly weighted and based on the winners of this crisis, namely technology and others. So that's why you cannot compare the stock market to the economy. In addition, of course, we have interest rates at zero. Basically, the valuation goes to the sky. So those two forces were extremely bullish for the stock market. Now, looking, for the next year or two, to me, any increase in interest rates will be marginal, and that's going back to the risk of a monetary policy error. If you wait and wait and wait and wait and wait until inflation is way too close, and then you raise interest rates way too quickly, that will be a dramatic event for the stock market, because the stock market can take a gradual increase in interest rates, but it cannot take a 90-degree type increase in interest rates, like 200 basis points in 2 days. You see, this cannot happen. And if it happens, it will derail both the housing market and the stock market. And therefore, in my communication with the Bank of Canada, and I talk to the Bank of Canada very often, unfortunately, we tell them, go early and go baby steps. The risk of moving early is much lower than the risk of moving late to the stock market and to the economy and to the housing market. And I think that they're starting to listen, and they're telling us that they're moving earlier than they believed. So that's the number one issue to focus on, the speed at which interest rates will be rising. Second is that clearly I see a change in leadership. So when it comes to the stock market, it's not really the index, it's really who is going to lead the index. And I believe that the laggers will become the leaders, like the airlines, all those sectors that are opening up slowly and valuations are so down, they will be able to benefit, while technology and others will do fine, but will not lead the pack.
The TSX also has had significant appreciation. It's up about 26% over the last 12 months, which has been significant. What do you think the prospects for the TSX looks like over the next 1 to 3 years? And why has it lagged the S&P 500?
Yeah, it's basically the same story. And it lagged the S&P 500 because we don't have technology the way they have. So we don't have as many winners. So it's the composition of the stock market. And if we are more towards commodities, and the commodity space will do fine because we are opening up and the global economy will improve, actually, we might be leading the US because of that.
So a lot of the people on the line watch CNBC. They've seen these interviews with Stanley Druckenmiller, the CEO of Duquesne, Mohammed El-Arian from Cambridge University. Both of them have been extremely outspoken in saying that Fed Chairman Powell was really smart about overstimulating in the heart of the COVID-19 epidemic, but they were really strong in their voice that they're being overstimulating in the midst of a very strong and recovering economy. And I guess I don't understand why there is this huge debate whether inflation is transitory or permanent. They expressed what you just said. Better to tap on the brakes now than to slam on the brakes later on, that the impact of going earlier is a much better long-term outcome than waiting and then slamming on the brakes. Why is there this huge debate? Why is there this dilemma, and why isn't there a more unified point of view?
That's a very good point. And listen, inflation is a very interesting creature. So now inflation is rising on a year over year by 5.66%. Why? Because a year ago, nothing happened. Prices were basically zero. Gasoline prices was very, very low. Now it's high. So on a year over year basis, you see a jump. And they say when you remove the year over year, it's not such a big deal. But it is, because you look at June. June inflation in the US was 0.9. The market expected 0.5. So much for economic forecasting. It's basically double what the market expected. So in a month of a month, things are moving even faster than expected. So inflation is there. But then they will say, yes, it's temporary, it's temporary, it's temporary. All kinds of factors were temporary. But I'm not so sure. Nobody knows. I'm sure that also in the 60s, when inflation was at 1 or 2% for a long period of time, they kept saying, and the increase is temporary, and it wasn't temporary. So we don't know. And we shouldn't pretend that we know. Yeah? Nobody knows. All those people that discuss it, they don't know. So the point here is that why don't buy insurance and just start raising interest rates? The reason why they're not doing it, I believe it's temporary. They say there's no reason because it's temporary. Second, they want, and that's very important, they want an inclusive recovery. They want the labor market to go back to what it was. Let me tell you something. Monetary policy cannot achieve an inclusive recovery. It's fiscal policy. It's the government. You want to deal with the income distribution, it's right and the right thing to do. But that's not your tool. That's not your business. It's the government's business. Monetary policy has to deal with inflation, has to deal with interest rates and where they should be. And at this point, there is no reason when the economy is rising at 10% to keep interest rate at zero.
Talk about the REIT index. A lot of people on the call involved in various REITs and various investments around different asset classes of real estate was up like 26% over the last 12 months. There's been a huge recovery. Is that something that you think has peaked, or do you think it continues to appreciate, but on a declining acceleration?
First of all, I'm not surprised by the improvement in the REITs market at all. I think that it was very predictable. We discussed it in our previous conversations. And basically, the market went crazy in the beginning of the crisis, believed that everything real estate is going to die. If it's office, if it's retail. And now people are starting to realize that's not the case. And, when you're in a situation, you exaggerate the long-term impact of that situation. And we were in a situation. Now people wake up and realize, the situation is not so bad. And the vacancy rates in offices will not kind of go up to the sky the way they predicted. Then you have industrial. This is still on fire and will continue to be on fire. So that's another factor. And even retail will go back, especially high quality retail. So when it comes to REITs, I will start focusing more now on what kind of REITs. So industrial, clearly, I think, although is expensive, it's not expensive enough, given the lack of supply. We all know that. Self-storage, another story that we see huge demand, not enough supply. So this is one thing that is happening, will continue to happen. We simply don't have enough supply. That's number one. Number two, retail. Offline shopping will be exotic, but the experience will determine where you go. So high quality will do well, low quality will not do as well. The office, I believe that class A, like nice buildings in downtown will do extremely well. B, C, not so well. That's the way I see it. And residential, that's an issue. Because I believe that we have an issue with purpose-built. The price of construction went up to the sky. You know it better than anybody else. It's in the sky, which means that in the condo space, if you build a condo, you can actually recover some of these costs through the price. Not so much in the purpose-built space, given the rental market. And that worries me because we need rental supply, and that's a mismatch in the market.
So just following up on that about purpose-built rental, I think it was about 6 months ago, we had this conversation. There was a decline in demand of Airbnb. There was price deflation of rental rates. They had gone down about 10%. Now there seems to be big buildup in demand for purpose-built rental. Pricing has gone up to sort of, I think, almost pre-pandemic levels. Demand keeps increasing. Are you bullish still long-term on the demand for both the value per month of purpose-built rental and the unit volume requirement to satisfy demand in purpose-built rental?
Absolutely, I do think that that's the case. I would like to see, quite frankly, more government assistance to purpose-built. Because at the end of the day, if you don't own the land and you do the economics, sometimes it doesn't work. And I don't see enough supply of purpose-built. I would like to see much more because, quite frankly, we have an affordability crisis in Toronto, Vancouver, and we need a solution. The solution must be a rental solution. Part of this rental solution must be purpose-built, not a condo market. The condo market is fine, but it cannot be the rental space. The new wave of renters will be families with kids. They want to deal with a company, not a landlord. We need more purpose-built in Toronto. We need more purpose-built in Vancouver. We don't have enough, despite the improvement.
One of the issues that you talked about was the inflation of construction costs. Lumber's fallen and was up fourfold. It's fallen in half. But if you looked at overall construction pricing today, and you had to forecast where it'll be a year, 2 years, 3 years down the road when people are building the actual condos, are you concerned still that there will be continued upward pressure on construction prices? Obviously, can't be at the same sustainable level it's been, but if you had to handicap over under where we are on construction prices for condos, where do you think it is over the next 1 to 3 years?
Yeah, because if you look at the cost of building a condo now compared to 5 years ago, you know it has risen dramatically with major implications for the price and even margins. What about the next 5 years? I don't see a situation in which all of a sudden things will change dramatically. Now, clearly, the rate that we have seen over the past 5 years, especially during the pandemic, will not be sustained. But can I see 5-6% increase, namely double inflation, 3 times inflation in construction cost? Absolutely. We have shortage of trades. We simply don't have trades in this country. We have to solve this problem. And immigration is not the only solution. We have to generate the trades. We simply don't have. Prices are rising. So I believe that something in the neighborhood of 6-7% a year is not unthinkable.
So housing has obviously been a top headline all across the media and on the minds of every investor. Across the country, the average housing across the country has risen 38% to $688,000. In Toronto, it's appreciated about 17%. We're at just under $1.1 million, about $1,089,000. Interesting that detached homes have gone up 25% to $1.4 million. What we have used internally, 3 to 5% increase in volume, 3 to 5% increase in price appreciation over a 5 to 10 year period. Are those reasonable assumptions? And if you were using handicapping, are we too light or too aggressive on both volume and price?
I think the composition of pricing will change a little bit, at least for the next year or two. Namely, I believe that the condo space will outpace the low rise in terms of price appreciation, the opposite of what happened during the crisis. Again, reflecting 2 things. One is I believe that the low rise segment of the market is simply very expensive. It's basically reaching a resistance level. It's not that people don't want it. They simply cannot afford it. So you go to a condo as an alternative, the more affordable channel. So I believe that at least for the next year or two, I will not be surprised if the resale market will basically close the gap with pre-sale in the condo space. So you see prices rising there. That's a given. And given the increased demand for rental, which will be coming with non-permanent residents and new immigrants, which are coming, clearly the rental market will go back to what it was and even worse than that. So that's one aspect of it. The other is the low-rise segment of the market that we simply don't have enough supply. So that will maintain the price, but will not accelerate it in a very significant way. So your assumption, a bit conservative, but reasonable.
So one of the controversies that we read about in the media every day is what can the government do to balance the affordability issue? Everyone is talking about taxes or other kind of policies to put in place to reduce demand. most people that we talk to say it's a supply issue. It's not a demand issue. How do you feel? And second of all, what concern do you have that the government will do something preemptively that would really stop the demand for housing by doing something precipitous that will not fix the problem? And what can they do to stimulate supply growth?
Well, over the past 10 years, the government introduced tens and tens of regulations on housing. All of them were on the demand side. And look where house prices are. So clearly it's not working. Why? It's not working because we are using demand tools to deal with supply issues. It will never work. The issue is supply. And we know the story. We have the places to build in Ontario. We have Vancouver, which is basically an island. We have major issues in terms of supply, and therefore we have to release more land where we can do that. And easy thing to do, speed up the process. You know better than anybody else how long it takes to get permits. Speed it up. Give them more resources. This can be resolved. We are talking about affordability. I just had the conversation with CMHC talking about affordability. I said, speed up the process of releasing land, and then prices will not rise as much. It's very simple. It's not the only solution, but it's part of the solution. Let's do what we can do at this point. And clearly, if you can release more land and be more creative on zoning. And then give purpose-built developers some goodies, incentives to build more, so we'll have more supply of rental units in this country.
One of the beneficiaries of what has transpired over the last 10 years in the real estate market has been immigration. It was anticipated that over a 3-year period, the government would open up the borders, and about 1.5 million people over a 3-year period, about an average of 500,000 immigrants would come to Canada. Do you still anticipate that when the borders open up post-pandemic? And if so, do you think that's a number that's conservative, reasonable, or aggressive? And do you think it's a growing number if you were to say it was conservative? And what do you think the impact is on the real estate industry?
Well, first of all, I think that the number will be about 410 a year, 410,000 a year over the next few years. It's not 500. We'll get there, but we're not there yet. There is another element that people have to understand, and that's non-permanent residents, that actually in terms of numbers is more important than new immigrants in terms of demand. And many of those non-permanent residents are big residents. So that's something that we have to take into account. Overall, Canada is leading the OECD in terms of population growth. Clearly, we have an issue that we have to attract them. You see, we have a situation in which we take for granted that people will come. But we are not the only aging society. Everybody else, with the exception of India, is aging. And everybody else is after those new immigrants. And they are not lining up. If you are in Mexico and you are an engineer, you have a good life. Why come and freeze in Canada? You see, we have to be more attractive to them. We should not take it for granted that they will come, because we want to attract those immigrants that will be able to lift the economy. And that's a challenge that we are facing. But I totally agree that the numbers will be there. And if you combine non-permanent residents and new immigrants, we're talking about a significant lift to the housing market that will continue to support valuations and demand.
And what percentage in your 410,000 immigrants coming to Canada are you anticipating to come to Toronto, the GTA, and Ontario?
We're talking about a significant number, something in the neighborhood of 150 to 180. So this is a very significant number,
Talk about what back to work looks like. There's a lot of controversy. A lot of businesses have started to come back to work. The big banks and other, downtown, companies have delayed that. What do you think that looks like, and how does it affect demand for office space over the, midterm?
I think that when it comes to downtown cities, office, the impact will not be very significant. And let's think about it for a second. You are a big bank, and what is real estate in terms of your total profit? Like a decimal point. What are people in terms of your profit? A significant portion. So if you have to cut 20% of your real estate demand and make some people unhappy because they will not have enough space, what's the cost benefit analysis here? So they say, you know what? We know that we rent a little bit more than we need, but the impact on the bottom line is not very significant, and we are buying flexibility. So I believe that's what CEOs of major companies in Bay Street are thinking now in terms of the real estate story. And therefore, I think that the impact on those offices will not be very significant. More concern on B and C type offices. That's where I see the situation a bit more problematic. That's where you see small companies, some people will be working from home full time. But overall, I believe that we will go into some sort of a mixed model where people will be working in the office. The office will be the main base, but more flexibility.
In the United States, housing was up about 26%. The average house, actually interesting, was only 377,000 across all of America, compared to 688,000 in Canada. And but interesting enough, the transaction volume went from a low of about 5.7 million in 2018 to about 7.1 million last year, expected to be about 6.7 million. Where do you see U.S. housing compared to Canadian housing in terms of sustainable growth over the next 1 to 3 years?
Yes, I think that the U.S. Housing market will do fine. You look at the fundamentals of the U.S. housing market, very different than Canada if you look at the country as a whole, because what is Canada? It's like 5-6 cities and a little bit around them. In the US, you have many, many cities, and you don't have the supply issues that you face in Canada in many of those cities. Yes, you have it in Manhattan, but you don't have it in other places. Therefore, their price acceleration is very different than what we see. So comparing Canada to the US in terms of price trajectory and activity is comparing apples and oranges. But I believe that if I look at the health of the US housing market, they went through the mother of all deleveraging during the 2008 crisis. They are in a good position to take advantage of low interest rates, and that's exactly what we are seeing.
Talk about cap rates. So 5 years ago, we got into the self-storage business. We were buying things at an 8, 9, 10 cap. Now they're 4 or 5 cap. Purpose-built rental 5 years ago was a 4 or 5 cap. Now it's 2, 2.5, 3, probably. You can't buy much under 3. Do you see sustained cap rate compression, or do you think we've stabilized? I mean, obviously, not all assets are created equal. You know, purpose-built rental and industrial will be one thing, self-storage versus retail or office. But in general, do you see, when you're advising your clients who are investors in the space, are they seeing get in now because we think cap rates continue to compress, or do they think it's time to be patient because they think there's an expansion of cap rates?
Well, that's a very good and difficult question because it depends on the asset. And of course, depends what happens to the 10-year rate that will impact cap rates. And I believe that the 10-year rate actually will rise a little bit from current level that are a bit depressed artificially. So that, of course, will have some impact on the cap rate. So if you look at the 10-year rate and you expect over the next 3 to 4 years, 20, 30 basis points increase in that rate to go back to equilibrium, I think that's something that you have to apply to cap rates, depends where you are.
So you've given us an excellent overview on many different levels of where we are and what it looks like. And you've given us confidence that we're in a pretty stable environment and we have a sound fundamental economy, unless the government, either through fiscal or monetary policy, does something preemptive and precipitous that has some negative or draconian impact. What is the biggest concern that could cause this stable and growing economy to derail?
My biggest concern is the one that I discussed earlier, and that's waiting for too long with interest rates. That's the number one risk that we can think of in terms of a monetary policy perspective. Fiscal policy, you can make mistakes, but those are long-term mistakes. If you wait and wait and wait with monetary policy and then you have to raise interest rates in a rush, that will be dramatic to housing, to the stock market, to the economy as a whole, because the sensitivity of our economy and the housing market to interest rates has risen. And it's not just magnitude, it's the speed. And that's why the earlier you move, the better. And therefore, I suggest that if we hear some tweets from the Bank of Canada and the Fed that they will be moving earlier, actually, to me, that's a way to long the market, not to short it.
Isn't the performance of the market recently that it's sort of plateaued a bit? Isn't it really an indicator that investors are starting to believe that there will be a tapering earlier than expected?
Yes, we are starting to see the market toying with the idea that the Fed and the Bank of Canada will taper and will start raising interest rates a bit earlier. Until very recently, people were talking about the Fed not moving until 2024. Now, the last time I checked, which was yesterday, they are pricing in September move, 2022. That's basically 2-year difference in terms of market expectations. You listen to the Fed and some people are tweeting there, you know what, let's move earlier to be safe. So we are in a process of transition now. To me, that's a very healthy environment.
You obviously at CIBC advise pension funds on their allocation of capital. The real estate sector has been a huge beneficiary that a larger proportion of pension fund money has gone into real estate vis-a-vis other asset classes. Do you see that trend continuing, and what have you been advising pension funds in relation to the prospects?
Yeah, pension funds have a very long horizon. They look at 10, 15 years, not 10 months. And if you look at real estate, you look at the demand-supply mismatch, you look at the growing cities in Canada, real estate will continue to do well, especially given the dividend that you get out of it. So to me, for many of them, this is a very secured, high-yielding environment in a low-inflation environment. And going back to inflation, one thing that we have to make clear, the issue is not inflation. Inflation, we know how to deal with. How do you deal with it? You raise interest rates. The question is how quickly you raise interest rates. And therefore, as far as those pension funds are concerned, I think real estate is a very interesting and a good long-term investment, given the return that you get in a low inflation environment.
The banks have been big beneficiaries of the growth of real estate. A big portion of their growth in their revenue and profitability growth has been real estate. Do you see, and they've had double-digit growth in that regard, do you see banks continuing to invest more of their balance sheets in real estate, and that will be a continuing growth asset class for banks in Canada?
I think that banks are very aware of their reliance on real estate and want to make sure that there is a threshold in which they don't cross. And I think that's more or less where they are. So you will see banks continuing to develop deep relationships with existing clients, but will not go crazy with real estate that will dominate their balance sheet. Clearly, you don't want to repeat a situation that we have seen in 2008 in the US, so you want a balanced portfolio, and that's more or less where we are.
Benjamin, I want to thank you on behalf of all of our Peerage Capital partners, colleagues, family, and friends, and all of our partners at CIBC. Thanks for taking the time. This is extremely insightful, very informative and enlightening, and we look forward to continuing this dialogue because it's been very valuable to all of us who've had the privilege of listening to you. Thank you to everyone for your patience and time and interest in the call. We will have a repeat of the call available if those people didn't have a chance to watch it. We hope you enjoy the rest of your summer. Stay healthy and stay safe. And on behalf of all of us, thank you very much. Have a wonderful evening.